Hi, it's Andy Hoffman, Media Director of Miles Franklin Precious Metals. It is Friday, April 4th at midday, and quite a day. Today's title is The Calm Before the QE Storm, and I couldn't be more vociferous about my belief in what's coming later on this year, likely. Last week I was off at a conference, didn't have my sound recorder, so it's my first audio blog in 2 weeks. But remember, just go on our blog every day. It's free, and you'll see all the other podcasts I do. I typically do 2 or 3 a week, as well as this audio blog. Anyway, this is a good day to be back in the saddle. The global economic meltdown is clearly accelerating. Massive QE increases are clearly coming worldwide, and today's NFP employment disaster, which I loudly predicted this week in several pieces, will likely serve as the coup de grace, in my view, of the recent blatant precious metals attacks, which have pushed prices to levels that have caused record physical buying, both physical gold and silver, plunging sentiment to the point where you have the average portfolio manager now going short, as they always do at the bottom, and very heavily oversold technical conditions, which only strengthened the double bottoms that were created by last year's attacks, and therefore giving you perhaps your last opportunity to buy at below the cost of production. All right, before I get to the NFP, let's start with Japan. Remember, I've been talking about how their national sales tax is increasing on April 1st from 5% to 8%, and that happened 3 days ago. And again, the last time they increased the rate on the tax, it was from, I think, 2% to 5% up back in 1997. It caused a catastrophic recession. Well, look where we are now. And they're going to be starting a sales tax increase. And in fact, next year it'll go up to 10%. And as they were putting this out, the yen has fallen to a new multi-year low, which is only going to fuel inflation. That's why they just had a 5-year increase, a 5-year high in energy prices and a 5-year high in their CPI inflation. But unfortunately, they just reported a 1-year low in their Tankin Sentiment Survey, which is pretty funny because 1 year ago is when Abenomics started. And also, labor earnings were down for the 21st straight month in Japan. So essentially, they're halfway toward doubling the money supply, and that's after increasing it by who knows how many times in the preceding years. And things have gotten dramatically worse, and now the sales tax is going to double. I continue to believe that Japan will be the first, quote, civilized nation to experience hyperinflation in the 21st century. And you have China, where they're basically the unwinding of perhaps the biggest economic bubble in history. I mean, making ours look like nothing has started. It's the biggest government fostered, privately speculated in construction, real estate, and credit bubble that the world has ever seen. And now you're seeing what do you call it, real estate prices. You now saw the composite PMI as published by the Chinese government fall from 49.8 in February to 49.3 in March. In other words, they are showing that they are contracting, and yet the government still says that they're going to have 7.7% GDP growth this year, which just shows you how ridiculous these numbers are that the government's put out. Remember the article we wrote several articles the last few weeks in China, one called The Most Terrifying Article I've Ever Read, about just how big this bubble has blown up. Another called Chinese Financial Water Torture, or Chinese Financial Torture, about the catastrophic impact of on derivatives of them letting the yuan fall, and of course it just makes the final currency war that much more intense as everyone seeks to reduce their currencies to nothing. Which brings me to Europe. It was talk that the ECB may actually initiate a QE program, or at least hint at one, at Thursday's meeting. And they didn't do that probably because their stock markets are still doing fine. And they're always looking for a crisis so they can get that last quarter point out. Right now their key rate is at 0.25%. But they did say that we are fearful of deflation. Remember what we wrote last week in our article called Deflation, with quotes around it, and recovery. And therefore they are considering a QE program. What a shock. And just today, I mean, this is Friday, it just came out on the tape that there's been an internal report that leaked out that showed they have considered a $1 trillion QE program, the ECB. which I assure you is coming. I would bet anything it's going to be coming this year. I mean, they're already doing plenty of stuff covertly, and they've been utilizing the Fed's swap agreement, which has been secretly around for several years, funding European insolvent banks. But this is going to be overt. This is going to show that the OMT is, in fact, a real thing, that, as I call it, Draghi's reckoning day is coming, where he has to back up his promise from July 2012 to do whatever it takes to save the euro. And again, this is why they've created massive financial inflation of, or I'd say massive inflation of financial assets. This morning, if you could believe this, Spain has a 24% unemployment rate, a 55% or so youth unemployment rate that's under 25 years old. And treasury yields on their 5-year yield just fell below 5-year US treasury yields. And Italian yields, Italy is possibly in worse shape than Spain. Italian yields are at an all-time low today. And it's because everyone is anticipating QE. It's exactly why the US Treasury yields are trading near all-time lows, despite the fact that we have record debt inflation, QE going on, and prospects for things getting much worse. I mean, these are all combined the biggest credit bubbles of all time. Although I suspect what's going on in China is going to make everything pale in comparison. Of course, it will have a tremendous global impact. Um, okay, so now let's go on to the United States. The news this week, a huge jump in the trade deficit, as if anyone would believe it would be otherwise. Big downward GDP revisions. Again, these are all counting gimmicks anyway. The fact that GDP would even be showed as positive is about as silly as China's trying to show 7.5% GDP growth when all their internal PMI indicators are flashing negative. I mean, you have a bunch of these diffusion indices come out in the United States. It really is remarkable. I remember when you'd have one or two economic data pieces every week or so, which you still pretty much have in Europe and Japan. But here we've got like 20 every week now. You got all these private groups putting out in these surveys, the ISM, the PMI, the Bloomberg, the this, the that, University of Michigan. In half the cases, you're finding out the high frequency traders are paying for this data beforehand, and somehow they're allowed to get it and use it to illegally trade on, et cetera, et cetera. And I'll talk about the HFT scandal in a second. But the fact is, these diffusion indices, as I've noted many times before, are a complete sham. They're just small sample sizes. They're rigged. Sometimes you'll see some of them will shoot up and then they'll plunge the next week. It's just completely immaterial. But the fact is, you've had this rising, let's call it weather hype, going on with the mass media here. They've been smashing gold and saying the Ukraine is fine and oh, everything is good as soon as the weather gets better, as if bad weather in the winter is something that's new. And as I wrote in my piece about a month ago called Mother Nature's Had Enough, all you have to do is look at the actual data and realize that it has nothing to do with the weather. The bad data was bad anyway. I mean, you've had some of the worst data in the places with good weather. And on a worldwide basis, this has been one of the warmest years ever, one of the warmest winter periods. The problem is that there's less flights in general, that there's less economic activity in general that has nothing to do with the weather. And then again, of course, you have the fudging of all these numbers. So the BLS with its NFP report and all the others, they can pretty much say whatever they want. They could say, China could say we have 7.5% GDP growth if they want. They could say they have 70.5 GDP growth. It doesn't matter. It's all lies. We all see what the real state of the world is. But anyway, going into this NFP report, at the height of, they've smashed the gold sentiment down from a 50% recommendation to a negative 10% recommendation, where all the hedge fund managers are saying sell, and all the gold newsletter writers are saying, look at my proprietary analysis, gold is going to plunge. Doesn't matter that it's all rigged markets and that gold and silver are way below the cost of production. That's what my proprietary analysis says. You should listen to us and do what we tell you and pay us big fees, et cetera, et cetera. You have all that. You have these technical indicators that are off the charts on the bottom. You have the commercials actually covering on the COMEX, which is always a bullish symbol. That is, if you believe the numbers, et cetera. But I digress. There was a lot of hype going into this NFP number. That they were good. There was whisper numbers. It could be as much as 275,000 jobs. It doesn't matter if they're even good jobs. Just that's what the mainstream media will focus on. And I had written the last 2 days, yeah, but look at the 10-year rates with all their hype about the economy the last couple of weeks. They've gone up, the 10-year rate has gone up to 2.8%. And as I wrote in my piece called 3.0%, enough said, because of the massive exploding debt in this country, it is not possible for the Fed to allow the 10-year rate to go over above 3%. And as a result, they will do anything in their power to make it go down. And thus, for instance, last month, the rate they had gotten down to 2.6% on the 10-year. So even though the ADP report from 2 days earlier was horrible, they reported a, quote, better than expected NFP report, so they could, write the headlines how great the economy is and smash gold. But now the rates are back up closer to 2.8%. They're like, look, we got to put out a bad report. And sure enough, they leave the birth death model number on their website completely blank, so you have no idea what it's going to be. And then bam, it comes out that most of the jobs come from this birth death model, and they reduced the birth death model this month, so it was a lower number than expected. Either way, the numbers last month, the numbers this month were just absolutely abysmal. They reported plus 192 versus the 206 estimate, which in itself isn't that big of a deal, except that, as I said, the whisper numbers were much higher. And of course, when you look at it, they're comically bad. The unemployment rate per se went up from 6.6 to 6.7. Even more comical because, I mean, how many times can I say this? 1.3 million people lost their long-term unemployment benefits in December. That's 3 months ago. And there's another 3.4 million scheduled to lose them this year, which is a quarter over. So theoretically, according to the BLS's definition, the labor participation rate should have plunged by another percent or so. And we should be talking about 5% or sub 5% unemployment rate by their definition by now. But they've just refused to do it. They're keeping it right above 6.5 just so that the Fed doesn't look that stupid for a year ago saying, well, if we get below 6.5, everything's all well and we'll raise rates. Now they're saying, yeah, we'll keep rates at zero for at least 6 months, if not longer, after we get to that level. And they won't even let it get to that level because, as Peter Schiff says, they used to just move the goalposts. Now they got rid of the goalposts entirely. And within the numbers, the plus 192, of course, plus 167 was the service sector, and plus 25 was goods producing. However, if you look at the birth death model, you realize, and all the breakdown of the components, the entire 25,000 of goods producing jobs were part of the birth death model. So they were really fictional jobs to start with. I put some tables in today's piece that you really should read it. It's called Why We Own Precious Metals, showing almost all the jobs were in the waiters and bartenders category, healthcare, temporary help. So even if you were trying to be bullish on the numbers, the fact is they're just completely horrible internals, as they are every single month. And of course, they're even those horrible internals are horribly overstated. This is a country that is in major decline, a Western world in major decline, and they can't even mask it with numbers. I mean, the fact that the mainstream media is desperate to, and the Wall Street and Washington are desperate to say things are good is one thing, but the fact is the real world is as bad as it's been. I would venture to say that as I put in my presentations, that this is the low point of the global economy that we've seen in our lifetimes, unless of course you were alive in the 1920s and 30s, or I should say just the 1930s. And what do you know? Here we are. It's Friday. It's midday, and the Dow is down a whopping 30 points, which is pretty amazing that they're able to hold it up when the Nasdaq is down 73 points, as its historic bubble is massively crashing. It's just getting started, in my opinion. And what do you know? The Treasury yield, which was 2.8% yesterday, is 2.72%. So Treasury bonds are soaring, as I told you they would, because the Fed cannot stop printing money. They have never, as I wrote in Proof of the Tapering Mirage, they have never tapered anything. In fact, they've printed far more than they've said, which is simple math based on the numbers that they put out and the selling of treasuries that is public. And as a result, the odds that Whirlybird Janet is going to reverse her tapering stance and actually, increase the QE sometime later this year are stronger than they've ever been before. Okay, so what do we got here? I figured I'd throw in a couple of things here, random things. One is Bitcoin. I'm not going to go too crazy, but since the Mt. Gox disaster a month ago, regular Bitcoin, as I call it, is down 50%. It's down 65% since November. You don't hear people talking about this great new change in the world anymore, because again, most people simply have speculated in it, not knowing the slightest thing about what it was, and now it's been exposed as having these ridiculous flaws that will take, in my opinion, years, maybe decades for people to understand. Perhaps there's a future in alternative payment systems in general, but to believe that a bunch of computer programmers who clearly can get hacked left and right or steal stuff, created some money, no. Bitcoin probably has less monetary properties than the dollar does, and so again, if you want to believe that just because people are angry at fiat currencies that Bitcoin is going to become the next big thing, you're welcome to speculate in it. But again, it's not money. All we care about now is, as I call it, financial defense, which is not to worry about what's going to be around 20, 30, 50 years from now. It's to worry about what happens when the world loses faith in these fiat currencies completely, as they've been all year. Look at the emerging market currencies. Look at the inflation we're having here in the United States, as I've been writing about. Look at my piece, California Inflation, that I put out. When it goes, no one's going to care about anything else except preserving their wealth, and that is going to be with real items of value. And the only real items of value in the monetary realm that are known in history are gold and silver. Yes, there are some substitutes. Some people say fine art may do it, or collectibles. Some people say Bitcoin, which has been around for 4 years, so some track record. But I can guarantee that when the blank hits the fan, that the only guaranteed thing that people are going to want to own are going to be physical gold and silver. Again, California inflation, that's where I was last week in San Diego, which I've been to quite a bit over the years. And I mean, it's almost like being in a third world nation when you look at the costs of living there. It's amazing. I mean, this is the nation with the state that it has more debt than Greece. It has the highest debt in the nation by far, way over $400 million, $400 billion, plus another 200 or 300 billion in municipal and unfunded liabilities, the highest unemployment rate in the nation, the lowest credit rating, which should be junk, but of course the credit ratings agencies are a bunch of liars that are paid off by the people that they rate. And then you have these droughts, which are as bad as any we've ever seen, and may last for centuries. I mean, forget years. This and the one in Brazil. I mean, these directly affect California more than any other state, and will affect everyone in the nation. That's why we've had literally a 20% increase across the board in U.S. food prices since the beginning of the year, coinciding, by the way, with a non-seasonal 11% increase in gasoline prices. And as I look at my screen, oil sitting well over $100 a barrel during the non-driving season as the driving season approaches. I wrote my piece, Is the Market Rigged?, on Tuesday or Wednesday, following the Michael Lewis book about HFT. I mean, I've written many, many articles about HFT in the past. One was called Going Bats, about that horrible Bats exchange. You should see look at on Zero Hedge, the guy, the CEO of Bats. He's on a debate with Michael Lewis, basically trying to patronize him and talk down to him, and saying that Michael Lewis is a liar. And then a day later, his own firm puts out a press release saying, yeah, you know what our guy O'Brien said on the interview with Michael Lewis? Well, he actually was lying. Sorry about that. HFT is a massive manipulation tool. But as I wrote in the article, and Bill Holter wrote in another article as well, the HFT, as far as we're concerned, is just another tool in the manipulation box. The bigger issue is that the major governments, the U.S. and the other Western governments, have been rigging markets to get to promote their the dollar strength and kick the can for years now. We're talking about the president's working group on capital markets and the stock market, the Fed and QE, the Exchange Stabilization Fund in gold and currencies, and all the other things that they do to prop up markets that they desire to be up, and attack ones that they don't. And HFT is just another tool that they use. It's not the ends, it's the means. But yes, there are a lot of criminals out there in this HFT market, and it just shows how degraded and depraved America has become, that they're allowed to do this in plain sight. Then I wrote a piece called Golden Lemonade on Wednesday or Thursday. It was actually referring to a great article by my good friend Jeff Nielsen of Bullion Bulls Canada, saying, well, how come the official central bank buying of gold has slowed down. I mean, certainly not the Russians, but a lot of their buying comes from their own miners. And of course, the Chinese, who the import numbers show have been dramatically increasing, but they don't report numbers. And no, they're not going to report a new number this month for their holdings because they did 5 years ago. They're not crazy. They're going to keep acquiring until there's no more to acquire. And that's what the topic of this article is, which basically says, look, the reason that central banks, assuming they aren't lying, are not buying more gold right now is either because they don't have the money to buy it, which of course they do because they all print money, or there's no gold for sale in size, which makes plenty of sense given how tight the physical market has been. Then I wrote about peak Wall Street, talking about, I mean, is the HFT scandal and all these other scandals going on as we see inflation around the world accelerate, showing that no, these banks and central banks are not infallible, and in fact they're going to be vilified and kicked out just like all the other ones in history have soon. I mean, they certainly will be. Have we seen the peak of their power? Don't know. But look, overall, this week, if anything, showed the calm before the global QE storm. Heck, I didn't even talk about the Ukraine. They're trying to talk about de-escalation. Meanwhile, as Bill Holter wrote today, I mean, the ramifications of what we've done with these sanctions. We've seen Russia sign all these non-dollar deals with India, with China, with Iran just in the last week. I mean, the writing is on the wall for A, the dollar, and B, fiat currencies. And in many ways, the Ukrainian situation, like Cyprus and many other flashpoint events we've seen in the last few years, is only going to accelerate these events. And again, as I said, calm before the global QE storm. In my view, Abenomics is going to be expanded before it ends in 12 months from now. That ECB will initiate this $1 trillion QE program sometime this year. And I believe Whirlybird Janet, with all of my being, will have to stop the tapering program shortly and perhaps turn it around. And if there's any kind of crisis, I mean, look at the NASDAQ here. If the markets really take off to the downside, they may have to do QE4 or QE5 or whatever number you want to call it. And that's going to be the end game. There'll be no turning around. If you don't have your gold and silver then, and I'm talking about the physical stuff, you ain't getting it because there's going to be shortages like we saw in 2008, like we saw in 2011, heck, like we saw last year, a year ago in April. And of course, if you are considering such protection of your assets, we hope that you'll give Miles Franklin a chance to earn your business. Again, we've been around 25 years, have an A+ Better Business Bureau rating, and have never had a client complaint. We've never lost a package, check, or wire. Our brokers have an average of 19 years of precious metal sales experience. And as we've seen this year in this business with the Tolvings and many others, this is not the time to be penny wise and pound foolish when it comes to, as Andy Schechner would say, when it comes to buying precious metals. And of course, we're competitive. You're not spending extra to use with us, but to try to be cheap at a time in an unregulated business where these kind of things are happening, it's silly. We will give you the best service out there, and we will be competitive as we always have. Just give us a call, 800-822-8080. And you can email me at any time at ahoffman@milesfranklin.com. Have a great weekend.